want to take some time to go over the exam number 2. I think it might be useful for me to provide a video going over that for everyone. So let me just sort of dig right in. If we are looking at question number 1. Question number 1 has a set of graphs. You'll need to refer back to the exam itself. I'm not going to bring that up here, but it asks for where is the equilibrium interest rate in the open economy, and that turns out to be 10%. It's where the difference between the current account in the home country is equal to minus the current account in the foreign country, or the difference between saving and investment in the home country is equal to the difference between, or the opposite, right? Saving and investment in the foreign country. Okay. So that's the 10% at that real interest rate. Saving in the home country is equal to 30. Investment in the home country is equal to 50. The current account's minus 20. The financial account's equal to 20, right? The current account plus the financial account equals 0. All right. This country is a net borrower. And over here, saving in the foreign country is equal to 70. Investment in the foreign country is equal to 50. The current account is equal to 20. The financial account is equal to minus 20. And the foreign country is a net lender. So the second part of that, of part A, all right, this is part A, right? Why any other interest rate cannot be the equilibrium real interest rate. At any other interest rate besides 10%, this equilibrium condition, won't be true. In fact, the economics behind that means that there'll either be a surplus of saving or a surplus of investment in the world economy, and interest rates will adjust in order to bring about an equilibrium between world saving and world investment, right? So another way to think about this is saving in the home country plus saving in the foreign country is equal to desired investment. These are desired levels, right? Desired level in the home country plus desired investment in the foreign country. So there's the world level saving, world level desired investment, and any other interest rate beside 10%. In this example, those will not be equal. Part B, question number 1. This is actually part of what we did just here. All right. How are they related? The financial account has to do with sales of assets or purchases of assets across countries, indicates whether a country is a net borrower or a net lender. This is how that's related to. So that's related to this, all right? And this. We know that the two are related because they have to be opposite sides of one another. Dollars flowing out for a trade deficit or trade surplus, dollars coming in need to go out in the other direction in order to buy assets or sell assets, or it could be real or financial assets. Right? So that's got to be the case. So these are all related to one another. So that's part B. And then part C asks, well, if the home country originally was a closed economy and then open to trade with other countries, what happens? Well, you know, the equilibrium real interest rate in the home country, if it was closed, is where desired investment and desired saving come together. Net real interest rate, it's about 13% in that diagram on the exam. If they're open to other countries, right, become an open economy, they can now they have access to a surplus of saving in other countries in the foreign country, right, at a lower rate, right? The interest rate is lower in the other country. And so the actual interest rate after trade opens up and trade of assets opens up, lending and borrowing, then it's going to settle somewhere between there, in this case at 10%. So that's what happens, in which case leads to a better outcome for the home country in this case if they open up. Well, clearly, if they had a closed economy, the real interest rate would be 13%, whereas if they were in an open economy, it's 10%. And so desired investment is higher in the open economy. Right. And in particular, that's going, and also while it has a current account deficit, it's going to be able to use those funds in order to get additional investment. And so in particular, this is one of the big benefits, right? That's going to lead to higher growth in the future, right? With more capital. So open economies tend to lead to lower real interest rates, which allows for greater investment in new capital, which is going to lead to longer term higher growth in the economy. All right, so let's take a look at question number 2. Question number 2 has a table with the federal government's budget balance and also the current account balance. In that case, right, what are we seeing is happening in that case? We'll see that over the years, from year 1 to year 2 to year 3, the budget balance is getting more negative, right? That's the second column of that table. So, right, the budget deficit is increasing over that period of time. And we see in the third column that the balance on the current account, right, is actually getting less negative. So the current account deficit is decreasing, right, from year 1 to year 3. Okay, they're moving in opposite directions, right? So if we were going to graph this year 1, year 2, year 3, and we were putting the current account and minus the government saving, which is the budget deficit. The budget deficit is well, let's actually put saving by the government, just saving by the government on this. This is actually what's listed here in the table, all right? And so it starts out negative and gets more negative from year 1 to 2 to 3. So, right, this is what happens to government saving, right? And we see that the current account deficit, right, is going down, but the balance on the current account is getting less negative, right? And so it's going up, right? So this is the current account balance, right? It's getting less negative. These are all negative numbers, right? But they're getting less negative, so it's increasing. They're moving in opposite directions. It's not a supply and demand curve. It's just plotting the data, right? So this is just plotting the data from the table. And question number 2. And so the question in part A, right, is what's happening, right? Are they moving in opposite or same directions? Do these data support or reject the twin deficits hypothesis? Well, this data runs counter, right? Rejects that to the twin deficits. Idea or hypothesis. Whoops. twin deficits hypothesis says that budget deficit, the current account deficit, move in the same direction. So it's different than what we saw in the homework that we did, right? It's the opposite case. This is actual data from a set of years in the US. So this is actually not just made up data, but it's a real thing, all right? If we were looking at the uses of saving identity, all right, from earlier in the semester, we have the following, all right? In this example, current accounts increasing, saving by the government is decreasing, right? So something's got to be going on here, right? Somewhere else. So either it's got to be the case that, whoops, let's use a different color there. So it's either the case that private saving has gone up, right, enough that it offsets the decline in government saving here, right? Or it's the case that investment's falling a lot, so that the right-hand side of the equal sign over here, right, is declining, right? So either private saving is going up a lot, investment is going down a lot, or both. Okay. Right. So more generally, there are 4 variables in this uses of saving identity. So we can't just say that these are going to move together or move in opposite directions. Anything is possible. It could be the case that they move together. Investment and private saving might not be changing a lot, but there's no necessary direct link between the two, right? So, what has to be happening for that to be true? Well, one of these 3 things. Now, what does this look like in terms of the open economy part C, which is the open economy model? How can we actually get this to be the case? Now, let's draw the model. Okay, it's going to be the case that the home economy going to have a budget deficit to start with. That's the real thing here in this data. Right, so we'll draw it so that this equilibrium, desired saving, desired investment, the real interest rate, INS, real interest rate. So the actual equilibrium is going to be, have to eyeball this, something like this. All right, there's the real world interest rate. This difference right here got to be equal to this difference right here. All right, so this is desired saving, desired investment. Oops, sorry. Well, we drew this wrong on the other side. Going too fast. Let's start this over here. Let's get this back again. All right. Higher real interest rate is going to lead to higher saving. That's desired saving. Lower real interest rate is going to lead to more desired investment. All right, so there we go. Let's call those the original ones. Okay. Now let's come back here. Let's pick a different color. All right, so what did we say? That one of the things is that either that could be happening or that could be happening. In either case, let's just do, let's finish this off over here. All right, we said that this distance right here, S0, Y0, I0, and S0 are the same, right? But opposite directions. So now oh, let's say that let's use this one. All right, let's say that desired investment falls here. Right. The question is, how can we get how can we get this, how can we actually get the situation that is occurring here to happen, right? So maybe it was the case, for example, that desired investment fell, right? Goes along with what we see up here, right? Now, if that's the case, we need to figure out where the new equilibrium is, right? It's the difference between this line and the desired saving line. So maybe it's something like, right, this distance right here. Equal to that distance right there. So what we see is national savings going down, investments going down. So in this case, right, what we'll see is that that we've got so it's led to desired saving going down, right? The real interest rate is going down, right? This is the new, whoops. Sorry. This is, oh, come on. This is the new interest rate. You'll see that the difference here, right? While those are equal, the current account deficit has gone down while national saving, right? Private saving plus government saving has gone down. Okay. And so there's a situation where we can get this actual difference between we can get, private saving. In this case, we're picking this one, let's saying this one happened, right? And it's going along with the data that showed this and this, right? So we've got the government saving going down, right? We have investment going down, and we have the current account going up. So how can that be the case, right? Well, in this case, the current account going up means it's getting less negative, right? And we have investment going down. So that's one way that we could actually get the kind of data that we see in that table. Okay? You have to kind of work it through to get the graph to match up with the data. Okay? That's the idea there. And the uses of saving identity actually helps to think about that, how that can happen. Okay? So question number 3. Okay. We have to analyze what happens if retail sales fall in the economy, right? In response to Federal Reserve interest rate hikes, etc. Again, this is an analysis of the open economy model. The idea that what's different here is it says we want the U.S. economy to start with a budget surplus. That's what's given in the stem of the problem, right? Okay, so it says that, to start with, the home country should be running a current account surplus, right? So that's the opposite of what we've done before, right? So this is home, or the U.S., this is the foreign country, desired saving, desired investment. The equilibrium and real interest rate is going to be about there, where these two differences, right, are the same. Called A, B, C, and D. So A, B equals C, D, those distances. And then what do we have happening is we have consumer spending less, retail sales fall, right? So less consumer confidence, people are saving more. It's going to shift this curve to the right, right? Spending less, saving more. And we got to find the new equilibrium, right? It's the difference between this line and the desired investment curve, right? So maybe about here. Right, it's the difference between here and here, 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 right? All that E and F, G, H. All right, so EF equals GH. Current account one country equals the negative the current account in the other country. Okay, so what do we see happens in this case? We see that investment and saving both increase in the home country. Saving decreases and investment increases in the foreign country. The real interest rate falls, equilibrium real interest rate falls, and the current account increases in the US. So, right, the current account surplus increases over here. This difference right here. The current account deficit increases. So that's the full analysis of that question. All right, so part B says, how does this example help to explain the phrase, when the US sneezes, the rest of the world catches a cold? Well, if there's something that happens in the in the US, in this case, there was a change in desired saving, but it could be a shift in any of the curves, right? What you're going to see is that, right, there's a difference, right? There's things that happen to investment and saving in the other country, even though they didn't do anything. They're just part of the open economy, and it just, as things reverberate, right? I didn't actually label those axes, right? As things reverberate through the world economy, the changes in the interest rate that are brought about by shocks or changes in the home country end up have an effect on other countries around the world. Right? And that happens in the open economy when the countries are large. Right? So when the US sneezes, something happens in other countries, right? And that actually is a phrase that is used and that you hear about, okay? Question number 4 has to do with the asset market. So let's think about that. These are questions that are very much related to the last homework number 5, right? So first of all, how can we just focus on the money market? We have to think about the asset market overall in the economy. And we've got to go back to this idea of the demand for how we hold wealth in terms of non-monetary and monetary assets. That's got to be equal to the supply of money and the supply of non-monetary assets. And we can bring these things to the other side. All right. So we're left with demand for money minus the supply of money equals the supply of non-monetary assets minus the demand for non-monetary assets. So when money demand equals money supply, then we know that demand for non-monetary assets equals the demand for the supply of non-monetary assets, right? So that's 0 and that's 0. So if we're thinking about equilibrium, if we look for equilibrium in the money market, we know that we have equilibrium in the rest of the asset market. So our focus is just on here. Why? Because the Federal Reserve can control the money supply, and and that's our focus of interest here. Yeah, we'll just leave that for part A, right? How does the Federal Reserve, how do they actually do that? What do they do to control the money supply? How do they do that? They buy and sell government securities, treasury bonds. By doing that, they can change the money supply and change the real interest rate. Okay, so they actually control the money supply. So if we were drawing that in terms of a graph, right, we'd have the real money supply. We have real money demand. And for a given level of real money demand, the Federal Reserve can, for example, reduce the money supply for a given price level. Oops. And if they do that, that's going to raise the real interest rate. Right? So if the Federal Reserve knows where the real money demand is, they can move the money supply around by buying and selling government securities, right, to create whatever interest rate target they want. And they do that on a daily basis. They're called open market operations. So as long as they know what money demand is, even if it's moving, even if money demand is changing, as long as they know what it is or have a pretty good estimate of that, they can adjust money supply in order to hit whatever real interest rate target that they are aiming for. All right. Part C is getting at that idea. All right. We have the percent change in the money supply is equal to the percent change in the price level, oops, inflation rate, plus the percent change in the demand for liquidity or the money demand, L, right? And the alternative interest rate that the nominal interest rate could get on non-monetary assets. Okay, so if the Fed wanted to hit its target of 2% inflation, right, which is the percent change in the price level, right, what information does it need to hit this target? If it knows what this is, right, let's say they know that that's growing at 2%, right, then they know that the change in money supply in order to hit this target, right, would have to be 4%, right? If this if they right, so as long as they know what, right, as long as they know what if this is stable and the money demand is changing at a relatively stable rate, then they can select the change in the money supply in order to hit whatever target that they're trying to get to. Okay, so they need to know that if they know two of the things, they just need to adjust the third one, right? The money supply. Okay, so for a given rate in real money demand, like 2%, let's say, what's the relationship between the amount of money and the amount of the price level? So if this was 6%, then this is going to be, inflation rate is going to be 4%. If they didn't change the money supply at all, then this would be minus 2%. If this was 2%, then this would have to be 0%. So if we graph those numbers, and we change, this is the percent change in P on the vertical axis, and the percent change in the money supply on the horizontal axis, right? Instead of the percent change is zero, right, in the money supply, then the inflation rate is going to be minus 2%. If it's 2% change in the money supply, then inflation rate is going to be 0%. Right? So this is like A, this is like B. Right? This is like A. That's like B. If the change in the money supply was 4%, then the price level is going to be changing at 2%. This is like C in that table above. And so if we do a line through all of that, right, the relationship would look like this. Positive relationship. The higher is the growth rate of the money supply, the higher is the inflation rate. So countries that have high growth rates of the money supply for a given money demand, right, it's going to lead to higher inflation. So there's a positive relationship between the two. Okay. Again, question number 4 is very, very similar to the questions that were asked in homework number 5. So question number 5, Federal Open Market Committee at the last FOMC meeting decided to raise the federal funds rate 0.25%, even though beforehand they were thinking about 0.5%. So first of all, why were they thinking a week or two before that meeting that they were going to raise interest rates 0.5%? Well, because the labor market is still really strong, unemployment rate's really low, high job growth, while spending was coming down somewhat in the economy, or the growth rate of spending was maybe slowing a bit. It seemed like a pretty strong economy yet. It was really resilient. And so they were thinking they might need to raise interest rates 0.5 percentage point to keep slowing things down, to bring the inflation rate down. Excuse me. Instead, just before that FOMC meeting, Silicon Valley Bank imploded, went bankrupt, and there was a banking crisis in other places around, not just in the US, but around the world. And that was going to probably leading to, and likely to lead to, less lending by other banks because they're a little more concerned about their own liquidity and their own risk management. And that has the effect of slowing down the economy itself, even if the Federal Reserve doesn't do anything. So they decided to reduce interest rates 0.25% rather than 0.5%, again, to try and keep the economy slowing down, right, to bring inflation rate down closer to its 2% target, because it's been persistently high, running around 6%. And depending on whether you use the CPI or the Personal Consumption Expenditure Price Index. But they didn't raise it as much as they were planning to, probably because the banking crisis that was emerging just before the meeting and continues to persist to some extent was already had the impact, having the impact potentially of slowing the economy. So they didn't need to raise the interest rate as high as they were originally planning to.